Now they'll want to talk about another tech titan. Bill Gates weighing in on the state of the economy. Listen to this.
The U.S. economy is doing well. Innovation in the U.S. is doing well. I think this is a period where the U.S. formula looks great.
Joining us now, American Action Forum President Douglas Holtz-Eakin. All right, Douglas, it sounds pretty bullish, probably as bullish as you're going to ever hear Bill Gates sound. What do you say?
He's a little more bullish than I am. I think the ideas innovation is in good shape. There's no doubt about that. But the translation of those ideas into actual business productivity has been missing for a couple of years, remains missing in action. And until we close that loop, until we get real strong productivity growth back, we're not going to see top-line GDP go above 2%. We're not going to see real wages start growing at a pace that Americans need and expect. And we're not going to have people feel like the economy is performing well.
Doug, when you talk productivity, because we hear it a lot, I know Alan Greenspan, the productivity miracle was the thing he pointed to a lot. For many, that's a euphemism for more people losing their jobs and robots and artificial intelligence taking it over. That's not what you're talking about, is it?
No, if you look back to that period in the 90s, we got the unemployment rate down to almost 4%. So this wasn't people losing jobs. This was getting more Americans to work than ever before. And at the same time, if those workers are more productive, then you can pay them more off the revenue they're generating without raising prices. And that's the magic sauce. If you can have those wage increases without corresponding price increases, those dollars are going farther, people are getting a better standard of living, and the economy is expanding the whole time. Right. To get back to that kind of productivity growth is absolutely essential.
All right, Peter Kiernan is with us. I want to get his take on that as well.
I like to hitchhike on the point because I do think productivity is the key. And one of the things we have to steel ourselves and prepare ourselves for, many existing jobs right here, right now, today are going to be disrupted in the next 10 years. And the challenge is to use that productivity, to use business investment to create new jobs, which will pay higher, but they need different kinds of training. And we need to adapt because the disruption is a matter of fact. It is going to occur, and we have to be ready to seize productive opportunities when they come up.
So you're talking more about a skills gap, not just STEM, but vocational and other areas as well.
I think the #1 issue we have right now is not necessarily bringing back manufacturing. I think what we have is a talent management issue. Right. We need to have our people ready. There are millions of great high-paying jobs that are open and available. They don't need the genius of job creation. We don't need Jeff Bezos to create them. They're out there. We need to train our young people particularly so they're ready to assume those jobs.
And to that point, the Empire State Manufacturing last time around said only 12% of those open jobs need a college degree, but they can't find skilled workers. Doug, I want to ask you about this. Investors perhaps feeling too confident. The much talked about volatility index, VIX, dropping to the lowest levels in 24 years. For many, that raises red flags.
Yeah, I'm surprised by this. There has been this sharp uptick in business confidence and consumer confidence. This is the reflection of that in investor confidence. But the fact is the U.S. economy is not out of the woods. We haven't shifted from a 2% growth rate to a 3.5% growth rate. We haven't really changed the trajectory that left so many people frustrated and unhappy. Until we actually do, I think investors should be a bit more cautious and be a little more strategic in where they put their dollars. Not everything is going to perform well.
Peter?
I feel very strongly that this low volatility is misleading. Just like you can drown in a river that averages 6 inches, excuse me, 6 inches in depth. And one of the problems is relevant volatility. If you miss your earnings, you will not go from very low volatility. You will experience enormous volatility. So there's stocks like Under Armour, miss a quarter, down 31%. Hertz, you referenced earlier, down 20% because they had double the loss they expected. All across the retail chain, huge losses. So volatility generally, very measured, very calm. Volatility specifically, if you miss your target as a company, you are going to have a major accident, double-digit losses. It's happening all over the place. And by the way, if you're a biotech and someone dies on your watch, all of your competitors will go down as well. This is a very tricky time. Do not be fooled, if you're an investor, by modest volatility claims.
And Doug, to that point, more recently there have been a lot more losers in the market than winners, but the structure of these major indices give weights to the big winners and kind of mask what may be happening broadly.
Yeah, I think Peter made a great point. I mean, all those examples are examples in which the market is going to discipline those who do not perform well. And that's how good market economics works. It rewards people who perform well. It does not reward those who do not. The real surprise is that somehow the macro environment, the global environment, is somehow perceived as more stable than it was in the past. I look around Europe, I look at China, I look at Japan, Russia, Brazil. I don't see anything in 2017 that looks so much more benign than we saw in 2016. And it's that decline in volatility that I think I'm confused by.
All right, guys, let's leave it there. Doug, thank you very much.